Hi, I'm so glad to be here to introduce our newest research in investment opportunity in IT industry. Let's firstly talk about our team, Genda, Jay-Z, and Anna. We are from Gabali School of Business, Fordham University, and major in finance. And then we will introduce our research path. And firstly, we will discuss the microeconomic situation and market volatility and to decide our investment opportunity to build that. And we will discuss why we choose IT industry as our goal. And we will talk about like our stock picking process and introduce some potential risk for you guys and make a conclusion. Okay, firstly, we will discuss the microeconomic situation and market volatility. Firstly, after 2019, the pandemic, there has been significant changes in the global microeconomic situation, such as global economic growth has slowed, inflation is one of rise generally, and interest rates are increased dramatically, and market volatility is intense. And one of the most important index to tell us the microeconomic situation is PMI. The Purchasing Manager Index typically released on a monthly basis and is available for both manufacturing and service sectors. We can say that the PMI index experienced a steep decline after 2019, and although it's temporarily recovered later, but from 2021 to the present, it has been continually decreasing. It indicates a recession or contraction in the economy or the specific industry, and it indicates a decrease in economic activity, reducing new reader orders and potential job cuts, supply chain issues, and inventory reduction. Next, we will talk about unemployment rate for various races of the United States have seen some decreases since the pandemic in 2020, indicating the positive signal of recovery of the economy. But they still remain at historical relatively high level. Next, the rise in the 10-year US Treasury bond yield may be attributed to increased inflation, economic slowdown, or Federal Reserve rate hikes. In the US, inflation has been on the rise in recent months, reaching the highest level in almost 40 years, 40 years economic slowdown and at 8.6%. It suggests that investors are concerned about the continued inflation. The rise of 10-year US Treasury bond yield can have impacts on higher borrowing costs and lower stock prices. So the rapid increase in the 10-year US Treasury bond yield indicates that investors are becoming more and more pessimistic about the future economic condition. It could have a negative implication for the economy. Okay, next we will talk about real-time data about like S&P 500 price. The S&P 500 price may be caused by the decline in economic growth, high inflation, and rising interest rate. Besides, a decrease in the S&P 5% can be a sign that investors are concerned about the future of the economy. Overall, like S&P 500 price changes are currently relatively stable, but the downward trend is becoming apparently. And for the market situation, we just ask AI firstly to list 5 events will influence the global market situation, and it gave me some 5 events like US-China trade war, COVID pandemic, Russian-Ukraine war, Federal Reserve rises interest rate, and Israel conflict. And although AI is a great searching tool, we still need data to support our conclusion, right? So we choose the VIX index. And the VIX index was like volatile in 2023. It rose to the highest level since 2022 in July as investors become concerned about the global economy. In 2023, the VIX index started the year at 70.5, I think, yeah, it then rose to the 30 in March. As investors reacted to the Russian invasion of Ukraine, the index then fell to the 20 in April, as the war in Ukraine appeared to the more stable. However, the index rose again to 33 in July and just raised to the 37 in October. I think as investors become concerned about the Federal Reserve plans to raise interest rates. Okay, combine what we talk about, we will choose our investment opportunity with the situation about recessionary and market volatility. And we choose to make our strategy into the long-term asset and a long-term investment. Because I think it's, economics are not good enough, right? Recessionary. So there's a lot of uncertainty and risk in the market. So we need to choose a long-term, more than 10 years to invest to make our investment portfolio or just make a good performance. And it will be relatively low sensitivity to recessionary rates and market volatility. And our aim is to achieve long-term returns from investing stocks and with solid performance and promising future outlooks. And our risk tolerance is moderate risk aversion because we are willing to take on some potential risk, and our teammates will explain that to you. Okay, next we will talk about why we choose IT industry from diverse industries. Let my teammates Anna to explain to you.
Hi. So AI capabilities have increased significantly in the past few years. So when we were trying to decide which industry to invest in, we used Bard to get a better idea. So we wrote a prompt to Bard that said, is IT industry a great investment opportunity in the market volatility, and why? So the reasons it gave was, firstly, the IT industry is known for its resilience and ability to adapt to changing market conditions. During a recession, business often rely on technology to streamline operations and reduce costs, which benefit IT companies. Additionally, the demand for IT service and products tend to remain strong even during economic downturns as businesses continue to invest in technology to stay competitive. In general, the IT industry also may have a positive correlation with inflation, as rising inflation can lead to increased technology spending by businesses. Moving on, we're going to look at a few reasons mentioned above to get a little bit more understanding on why IT industry is the best industry to invest in. Reason one, relatively low sensitivity to recessionary and market volatility. So we found this data using ChatGPT. So we wrote a prompt that said, list top 5 industries with relatively stable and less affected by economic cycles based on sectors S&P 500 index sorted. And as you can see, the IT sector was one of them. Reason 2 is high returns. This chart represents the cumulative returns for each of the 11 sector ETFs and compares the returns with the S&P 500 index as well. The graph was drawn using a code given by ChatGPT. The prompt we wrote was, using Y Finance to get the returns for the 11 sectors ETFs and the S&P 500 for the past 5 years, and calculate the cumulative returns and draw a line chart using the data. The result is the chart that you see here. As you can see, the data shows that the IT sector, which is XLK, represented by the gray line, has the highest returns when compared to other sectors and the S&P 500. The third reason is strong demand and promising growth. To analyze this reason, we looked at the job market. This chart represents the historic IT job market, and this shows that there has been an upward trend in the job market. And based on our research on the industry, we believe this would continue to increase. The next slide also analyzes the third reason. but this looks at the spending done by the IT industry. The above chart analyzes 5 segments within the IT industry. Each segment has shown an increase in spending in the last 10 years. This proves that the industry is focused on growth and is trying to innovate and make their products more efficient so that they're able to meet the customer's needs better. And the next slide, my teammate is going to take it from here.
Thank you, Anna. The fourth reason is solid profit and promising growth. As we can see from this graph, since 2016, business process outsourcing in the United States has been steadily increasing, with a noticeable surge from 2020 onwards. This is represented by the blue line. Business process outsourcing, or BPO, is when a company hires another company to do some of its work for it. This can be anything from customer service to IT to accounting. BPO is growing in the United States because it can help companies save money and improve efficiency. IT outsourcing, represented by the gray line, is the fastest growing segment of BPO because IT systems are becoming increasingly complex and businesses need help managing them. The IT industry is constantly changing with new trends always emerging. The COVID-19 pandemic made businesses realize they need digital solutions like remote work and data security. Many companies now get help from outside experts to adopt these technologies quickly. There's growing demand for IT services that keep business running smoothly and make them ready for future disruptions. This is why the IT services market has been growing steadily since 2020. Cloud technology is becoming essential for this digital transformation, and more companies are using IT for their services and upgrading their tech systems. These facts show a solid profit and promising growth for IT industry. Now, we asked ChatGPT to write a Python code to download CPI index from the Federal Reserve economic data and to download the last 10 years of IT industry returns, using NASDAQ as an example, and then calculate the correlation between the US inflation rate and the returns of the IT industry in 10 years, and to plot a scatter plot with a regression line. This graph shows a moderate positive correlation between the US inflation rate and the IT industry returns, with a correlation coefficient of 0.58. It's not a strong correlation, but it means that as inflation increases, IT industry returns also tend to increase. There are a few possible explanations for this correlation. One possibility is that IT products and services are often essential and difficult to replace. But it's important to note that the correlation between inflation and IT industry returns does not necessarily mean that inflation causes IT industry returns to increase. But IT stocks tend to outperform when inflation is high. Additionally, IT companies may benefit from increased demand for their products and services during period of high inflation as businesses and consumers look for ways to improve their efficiency and productivity. We asked AI, what characteristics does the stock have to perform well during a recession and market volatility? And some of these characteristics are strong balance sheet. Companies with a strong balance sheet are better able to withstand economic downturns. This means they have a low levels of debt and healthy cash flow. Stable earnings or revenue growth, offering confidence and reduce investment risk. Companies that pay dividends are often seen as more stable investments. This is because they are committed to returning cash to shareholders even during difficult times. Strong brand recognition and customers' loyalty often result in pricing power and recurring revenue. A diversified business model that helps mitigate risk associated with single markets or products. And large cap stocks are generally considered to be less risky than small cap stocks. This is because they're typically more established and have a longer track record of profitability. So we're looking as a strong buy, a stock that has low PE ratio, high dividend yield, and high Sharpe ratio. But of course, we're going to consider other financial ratios as well. Now, based on these characteristics that the stock has to have to perform well during the recession and market volatility, we asked BAR to provide us 3 stocks that has these characteristics. And it gave us Broadcom, with the ticker AVGO, Advanced Micro Devices with the ticker AMD, and Adobe with the ticker ADBE. And now Anna will tell us more about these stocks.
So as mentioned by my teammate, the stocks we chose are AVGO, AMD, and ADBE. We chose these three stocks particularly because these stocks belong to the same industry, have similar market caps, and had the most potential to make money when compared to other stocks. Our aim is to provide you sufficient financial data to prove which stock is the best to invest in. We also decided to compare them with the returns of market index and the IT sector ETF to see how they correlate with these sectors. This would give a better idea on how risky each stock is. So the first company we're analyzing is Adobe. Adobe Inc., formerly Adobe Systems Incorporated, is an American multinational computer software company incorporated in Delaware and headquartered in San Jose, California. It operates as a diversified software company worldwide through three segments: digital media, digital experience, and publishing and advertising. It has its presence in multiple countries, including but not limited to Canada, Germany, United Kingdom, and India. Looking at the financials, Adobe has a market cap of $246 billion, gross income of $15 billion, and a gross profit of 86%. The company also has assets worth $29 billion and liabilities of $13 billion. Adobe has always tried to maintain a strong presence in the creative and digital media industries. Its software is widely used by professionals and enthusiasts alike, and the company continues to evolve its products to meet the changing needs. The next company is Advanced Micro Devices, or AMD. It is an American multinational, and the company was founded in 1969 by Jerry Sanders, and it is based in Santa Clara, California. It is a semiconductor company that develops computer processors and related technologies for business and consumer markets. The company has a market cap of $164 billion and a gross income of $8.5 billion. Its assets are $67 billion and liabilities are $12 billion. Other notable finances for the company include: over the last 5 years, AMD has demonstrated a pattern of annual revenue growth. AMD's total revenue amounted to $21 billion, showing a slight decrease from the previous year's $40 billion, but slightly high, still significantly higher than the $6.21 billion recorded in 2018. EBITDA has experienced a consistent annual increase, climbing from $621 million in 2018 to $4.7 billion in 2022. In summary, AMD's financial performance showcases ongoing revenue and EBITDA growth, signifying an enhanced financial position over the past half decade. This can be attributed to AMD's expansion in the computing and graphics sectors, as well as increased revenue in the enterprise, embedded, and semi-custom segments. The final company we are considering is Broadcom Inc. Broadcom Inc. is an American multinational designer, developer, manufacturer, and global supplier of a wide range of semiconductor and infrastructure software products. It was founded in 1961 and it is headquartered in San Jose, California. The company has a market cap of $246 billion and a gross income of $20 billion. Its assets are $73 billion and liabilities are $50 billion. Broadcom has grown through strategic acquisitions over the years. Notable acquisitions include the acquisitions of Avago Technologies in 2016, which resulted in the company adopting the Broadcom Inc. name. It also recently acquired a company called VMware, which is an Indian-based software company. The company also has a heavy global presence with offices, researches and development centers, and manufacturing facilities in multiple countries around the world. These locations may include countries in North America, Europe, Asia, and other regions. The next few slides are going to be analyzing the financial data in depth for each of the companies to give a better understanding of the company's capital structure and financial health, and which would be a better stock to invest in. The first thing an investor would want to know is, can this company give him returns? In order to answer this question, we asked ChatGPT to create a line chart that shows the trend of annual rate of return over the past 5 years. The prompt we used is, use the Y Finance library to fetch historical stock data, calculate daily returns, and then plot a line chart which indicates the increase in the annual rate of return for the stock symbols ADBE, AVGO, AMD, XLK, and SPX. We can see from the graph that AVGO has the highest returns, even when compared to the IT sector ETF and the SPX. AMD is close, but looking at the trend, we can see that AMD is very volatile when compared to AVGO and ADBE, as these companies have a more consistent growth in returns. So we can conclude that AVGO is giving better returns when compared to the other stocks based on this line chart we created. The second thing that investors care about is how risky is an investment. This is where Sharpe ratio comes into play. A Sharpe ratio of 1 is great, but a Sharpe ratio of 2 or more is excellent. So we calculated the Sharpe ratio for each of the stocks, the ETF and the SPX. We took the help of ChatGPT to create a code to calculate the ratio, and the prompt we used was, can you give me a code to calculate the annual rate of return and the Sharpe ratio for the stock of AVGO and the other stocks? So considering the data, we can see that AVGO has the better better Sharpe ratio when compared to the other ones. ADBE has a current better Sharpe ratio, but looking at a longer term return data, AVGO is a better investment. But when compared to the ETF or the SPX, AVGO still has a better Sharpe ratio. My teammate is going to talk about the other ratios that we considered for the financial health of the companies.
Now let's take a look at the valuation ratios for these three stocks. The PE ratio represents how much investors are willing to pay for each dollar of earnings. A lower PE ratio is generally more attractive, as it suggests that the stock is undervalued in relation to its earnings. In this case, AVGO has the lowest PE ratio, 26.24, making it relatively more attractive based on this metric. EPS is a measure of companies' profitability. A higher EPS is generally better. Among the three stocks, AVGO has the highest EPS at 32.52, indicating strong earnings per share. Beta measures the stock's volatility in relation to the overall market. A beta greater than 1 indicates the stock is more volatile than the market. Among these three stocks, AVGO has the lowest beta at 1.129, which means it's relatively less volatile than the other two stocks. Our investors' risk tolerance is moderate, willing to take on some risk, so we think this is a good choice. The current ratio measures the company's ability to cover its short-term liabilities with its short-term assets. A ratio above 1 is generally considered healthy. AVGO has the highest current ratio, 2.496, indicating it has a relatively strong short-term liquidity. We also analyze the profitability and performance ratio. Return on asset measures company ability to generate profits from its asset. A higher return on asset ratio is generally better. AVGO has a high ROA ratio, indicating strong asset utilization. Broadcom has almost the same ratio as other, but well above AMD's ratio. So we consider other ratios as well. Return on equity measures companies' profitability in relation to shareholders' equity. AVGO has the highest ratio, 64.76%, signifying strong returns for shareholders. A higher dividend yield indicates a company's willingness to return value to its shareholders. AVGO has the highest dividend yield, 2.16%, making it more attractive to income-oriented investors. Another ratio we consider is profit margin. Profit margin indicates a company's profitability, and as we can see, AVGO has the highest profit margin, which suggests efficient cost management. As Anna mentioned, Sharpe ratio is one of the most important ratios, and it measures the risk-adjusted returns of the stock. A higher Sharpe ratio implies a better risk-adjusted return. In this case, AVGO has the highest Sharpe ratio, 2.787, which suggests it offers better risk-adjusted returns. We also consider some potential risk associated with AVGO. We compared interest coverage ratios and debt-to-equity ratios. Now, interest coverage ratio indicates a company's ability to cover its interest expense. A higher ratio is generally considered more stable. ADB has the highest interest coverage ratio, signifying strong financial stability in this aspect. A lower debt-to-equity ratio is generally preferred as it indicates lower financial leverage and risk. Based on the analysis, ADB has the most attractive debt-to-equity ratio, indicating that the company has a low level of debt relative to its equity. However, AVGO has a reasonable debt-equity ratio and good interest coverage ratio, indicating that the company is generating enough earnings to cover its interest expense. And we came to this conclusion based on our research of the history of AVGO. And now Jay-Z will talk about our conclusion.
Well, when it comes to seeking opportunities in the investment market, we need a solid economic foundation to guide our choices. AVGO, with its relatively strong economic fundamentals, shows us with an excellent and fabulous and wonderful long-term investment opportunity, especially during a period of frequent market turbulence. To arrive at this conclusion, we conduct a comprehensive analysis, taking into account variable factors such as valuation, profitability, and financial stability. AVGO shows us a compelling profile, making it the most appealing stock option. The company boasts a favorable PE ratio, strong earning per share, a generous dividend yield, impressive profitability, and a commendable Sharpe ratio. Considering how well these attributes align with our specific investment objectives and risk tolerate, we see AVGO as a highly attractive investment proposition. Of course, this important acknowledge that every investment carries some degrees of risk, right? So with AVGO, there are potential risks related to its higher D ratio and lower interest coverage ratio. However, taking account all of the financial factors, we firmly believe and we are so confident that say that the stock is a strong buy. When making investment decision, it's important to weigh risks and the rewards, and AVGO seems to be a wise choice in that regard. Thank you.
Thank you.